The secret of volume clusters before price breaks, Tongue Range Trading Codes welcomes you and your friends. There are things that are quietly happening just when you think the market is resting. The sideways candles, the boring tongue range that lasts for weeks, even months, you pass it by as a meaningless part. But it is in that silence that the biggest scams are being prepared. It is also in that time that the sharks silently move money, coordinate crowd behavior to rearrange the entire market situation. You cannot imagine that a seemingly unexpected breakout tomorrow has actually been carefully prepared for several weeks. Starting from very small, very subtle volume clusters, but they are signals for a larger plan taking shape. And if you still think volume is just buying and selling volume, today's video will completely change your thinking. Please share and save this video, because I'm sure if you just watch it all and contemplate it, in the next few months, you will no longer look at the chart the same way, and you will no longer be fooled by seemingly random breakouts, but in fact, they are deliberately designed traps. Let's begin. First of all, to understand why volume clusters are important, you need to understand one thing. The market is not designed for you to win. It is designed for those who know, who are hidden, to be able to take money from those who are too predictable. An accumulation zone on the surface is a period when prices move in a narrow range with no clear trend and no sure entry point. But under the surface is a silent war between the sellers and the sellers. And volume is the only trace left in that war. In an accumulation zone, you can see many small candles or a mixture of red and green. But if you only look at the colors or candles, you will not understand anything. You need to zoom in on each volume cluster, each trading session, to see whether buying or selling pressure is really dominant. More importantly, you need to see where that volume cluster appears in the accumulation zone, near the bottom or near the top. After how many silent sessions does a breakout start? Imagine the accumulation zone as a dark room. Volume is the light shining on each area to help you guess who is standing where, who is quietly loading up, who is impatient to escape. One of the common signals is a sudden increase in volume, but the price does not go far. This happens when one side buys a lot, but still tries to keep the price in the accumulation zone. The purpose is to not reveal their plan. That is a sign of absorbing volume, the absorbing force. And if you see that repeated many times in the same price zone, it is very likely that a breakout will come and go very far. On the contrary, if you see volume increase but the price jumps out of the accumulation zone in just one or two candles, be careful. It is usually a fake breakout. The fat guy just finished selling and used the last volume to create a final push to attract small investors, then the price immediately reversed. Many people are fooled because they only look at the volume at the breakout candle, but the professional looks at the entire volume before that, and that is where this video takes you. Look at the gold chart in early March 2022. The price was sideways around 1930 to 1950 for 2 weeks. Everyone thought the market was changing, but if you observe carefully, you will see that every time the price slightly decreased to 1930, there was a strong increase in volume, a long lower shadow candle and a higher close, and such times repeated at least 3 times in 2 weeks. That is not a coincidence. That is accumulation. Then there was a breakout candle to 1960. The volume wasn't that big, but the price didn't turn around. And from there, gold continued to rise to 1980, within 3 days. The buyers of the breakout didn't need to know any reason, because the sharks had already gathered enough stock. They were just riding the wave. The problem is, if you don't read the previous volume pattern, you won't have the confidence to enter. And if you enter late after the breakout, your risk is much greater. The question is, how do you know which volume pattern is reliable? The answer lies in the repetition and the mismatch between volume and price. If the volume increases sharply, but the price remains unchanged, it's absorption. If the volume is high, but the price forms a doji or long shadow, it's oversupply or undersupply. If the volume increases gradually while the oscillation range narrows, it's a sign that the market is about to compress. These things don't happen randomly. Remember, the market always signals before it acts, but only those who are patient enough to observe will see it. If you are a new trader, start practicing reading volume clusters in the tongue area instead of jumping into orders on breakouts. Observe, take notes, review past charts. That is the only way to improve your analytical thinking. In an interview at the end of his life, Richard Wyckoff, the master of volume analysis, once said that the market is a game of hidden information. But if you know how to look at volume, you will see what is hidden. The advice here is not to guess every breakout correctly, but not to guess blindly. Read the tracks that the sharks leave. Watch the volume clusters. Remember, the price never breaks randomly. It only breaks when the market controller has finished preparing. You can imagine a tongue area as a stage being set. The audience has not arrived, the curtain has not yet been drawn, but the director has quietly arranged the actors, the lights, the sound. And when everything is ready, in just a few minutes, the curtain is drawn and the play begins. In the market, too, a breakout is just a brief moment. That is, deciding your direction. But the real nature is the whole preparation process behind it. And the volume clusters are the footprints of the directors of that play. Interestingly, most traders only act when everything has started. They see the breakout, they see the price explode, they hear positive news, and they enter. But by then, it's too late, because sharks never create waves to buy, they create waves to sell. And if you're a buyer when the wave just appears, you are most likely the one who gets sold back the goods they have been holding on to for a long time. The key, again, is volume, but not single volumes, but clusters of volumes appearing intelligently, cyclically, with intention. Just look at the crypto market in early November 2022. Bitcoin moved sideways around the $17,000 to $18,300 range for almost 14 days. Some people call it a holding range. Others say the market is dead. But if you look deeper, you will see that in 4 times the price tested the bottom of the $17,000 range, there were clusters of high volumes, candles with short legs and closed higher. Meanwhile, the peak test had very low volume, the price was pushed down immediately after. Then one day, the price suddenly rose to $18,700. And the strange thing was, the volume on that breakout day was lower than the previous tongue accumulation days. Newcomers were skeptical. Why was the breakout volume so low? But those who understood well knew. The sharks had gathered enough goods, there was no need to pump more volume. The breakout was the final performance so that those who had not yet bought would rush to follow. And just a few days later, Bitcoin reached $21,000, a gentle but effective wave. Those who read the volume cluster before the tongue accumulation zone entered orders early, stopped short, and made profits. The question is, how do you distinguish real volume clusters from fake volume? Real volume is often independent, it doesn't appear alone. It is a series, usually 3 to 5 consecutive sessions with high volume at the same price range. It comes along with the candlestick, especially the lower shadow in an uptrend or the upper shadow in a downtrend. It does not push the price too far immediately. Instead, it keeps the price in the tongue area, showing that there is an absorption force behind it. Fake volume often accompanies news. It only happens in one session, the volume spikes, the price bounces strongly, and then quickly reverses. Such volume clusters have no preparation foundation, no tongue accumulation before, and so that breakout has no lasting force. Professional traders do not buy breakouts because of news. They buy when they see preparation. They buy when the volume clusters signal that the sharks are gathering, not when the crowd is excited. Remember a simple but profound principle. The market precedes the news and the volume precedes the market. So if you wait for the news to come in, you are already twice too late. In the journey of practicing reading volume clusters, what you need is sophistication. There is no mechanical formula, but an intuition that is gradually formed through experience. When you look back at many charts from the past, you will start to feel that something is building up. Someone is preparing. There is a price zone where the sharks do not want the price to fall below and do not want it to go too far. There is a very special compression between price and volume. Volume is compressed, the amplitude is narrow, fluctuations are decreasing, but volume does not disappear. It just changes roles. Sometimes it increases slightly, sometimes it decreases slightly, but it is all within the control zone. That is when the market is about to explode. And when it explodes, if you understand, you are not surprised. You do not need to chase. You have been there before. Practicing reading volume clusters requires one thing. You have to stop expecting, enter immediately. You have to change the state of a reactor to an observer. You have to be patient, waiting for signals instead of jumping on every price move. One of the most effective exercises is to pick 10 accumulation zones on the past chart. Look at how the price went before, then zoom in on each volume cluster, each trading session. Note the